And now I'll pass this on to Eric. So today in the current environment, what do you kind of expect to see if you actually had someone come in the door that you thought was worth an extended conversation with it? So also, I think it might be helpful. How about a little bit of comparison of perhaps that's different from, say, 5 or 6 years ago?
Sure. So at Sevin, I'll give you some context also, because I think the answer to my question relies heavily on what kind of firm Sevin Rosen is and how big our fund is. And that's actually one thing I hope everyone leaves with, because it's something that, as an entrepreneur, you really don't have very little visibility into, which is you should really think about who the investor is that you're approaching and when you're approaching them, because larger funds are going to have different expectations in terms of what kinds of companies they want to invest in, because they're looking for the certain size outcomes. Whereas smaller VC firms, angels, will have different expectations, and they will work not only with different phases, but different classes of companies in terms of what their opportunity set or market that they're entering. So the answer to your question from Sevin Rosen's standpoint, we tend to have larger funds, $300 million funds, the kind that you think maybe in Silicon Valley, those type larger traditional VC. And for us, it has to be something that we believe can grow into a very large business. If the company doesn't have potential to exit, either through an M&A or one day maybe IPO, if that ever comes back, if it can't exit at over $100 million, $200, $300 million, it's really not going to deliver the kinds of returns that we need to give back to our investors. The reason we do this is because our investors have certain expectations in terms of the kinds of returns, the kinds of bets that we're going to be placing. And so that's why we need a lot of those big wins to offset all the losses that are going to happen because of the number of deals we do and the size of the fund. So I would just consider that, because I would say vast majority of companies that I meet that are great investments still might not be a good match for a fund like ours, just because of where they fit on the spectrum. But in terms of what we're looking for more generally, and I think this would be true across the board, is it's regardless of the economy, you really want to show some sort of traction. And traction is kind of a buzzword that I think a lot of VCs use, and that can mean different things depending on the business. So if you're a consumer internet kind of Web 2.0 type site, traction really means that you're showing some kind of viral growth and adoption, that people are just talking about you and you're growing really fast with very little or no marketing spend, because your product is doing something so innovative or has some viral component to it that allows it to grow really quickly. That being said, the difference between today and probably 4 years ago is it's not just enough that you've shown that viral growth, but that now you actually have some kind of business model that shows some promise. It doesn't have to be completely proven out. Even for people like us, we do early stage investing. We do seed and Series A. Probably not as small check sizes as angels might, but at the same time, I think angels in this environment too are looking for some hint about the business model. I would also say that there's probably less tolerance for me too type startups or small variations of things that are already popular. Whereas in what I would call frothier times, when you have a lot of money and a lot of people with bright-eyed optimism, people will say, oh yeah, okay, you're going to be Twitter 2.0 or something, and fine. But really, I think in this environment, you're looking for really strong, sustainable differentiation. And that's an MBA word to use, but it's true. That's what people are looking for, something that really sets you apart, will give you an advantage in the marketplace that you can sustain over time. That could be at the product level, that could be in the business model. Maybe you're doing something that's unique in terms of the business model, but that's really...
And I want to ask one clarification question sort of beyond the Sevin Rosen. Given the contraction in the number of VCs that are out there, have you also seen an equivalent traction in the VCs that will do seed and first round? Have you seen people move out of that and now they're typically...
Well, it's actually funny that you say that. What's actually happened, it's kind of counterintuitive. Well, I should say overall you're right. So there's a contraction in terms of the number of firms. You're going to see a lot of firms closing down. You're going to also see that the fundraising is at the lowest that it's been since '95. This is actually good for the industry in some ways, and I would make the argument it's good for entrepreneurs, though that sounds counterintuitive also. It's good for the industry because you don't have a bunch of copycats coming after you, and you're not burning a lot of cash because you're not competing. And you instead of having 10 people in a category, you have 3 in a category, and that's why it's good for you as an entrepreneur. But back to your question, you'd think that because there's contraction, people would be more risk averse and go away from early stage. But actually, it's gone away from the middle. So what's happening is you're actually seeing a lot of people return to the roots because it's also capital efficient, smaller check sizes. It's not writing $10 million for something that's not proven. Of course, if you saw that Twitter just raised $100 million, everything I'm saying is BS, but that's an exception, I'd say. For the most part, what you'd see is that you're starting to see a lot of people get back to seed investing, early Series A investing, really thinking about stages and capital efficiency. That's another buzzword that VCs love to use. And then you're also seeing investments where people have proven out a lot of the assumptions in their business model, and it's really about growth and getting on the bandwagon. So, where people are hurting, or if you're in the Series Bs are the ones that are really painful. That's the ones where VCs are struggling to get other VCs to come in, and they have to support their investments on their own for a longer time than they thought because of the economy. But your plan said you were going to get break even in 2 years, but now because the economy is taking 3 years, wow, you need another $3 million, $4 million. Where is that going to come from?
If I compare to